Hi, and welcome to this event where we have the pleasure to present MPC Energy Solutions. To help us through today's presentation, we are joined by CFO Stefan Meisner. Today's event will be a short introduction to the company, the investment case in solar, especially in this region where you are situated, maybe not that familiar to many Nordic investors, but let's talk a little about the advantages and disadvantages of the Southern American region. As always, you are encouraged to ask questions. Do it in the box down below. Do it through the presentation. Do it in Danish. Also, we will do this in English. But if you do it in Danish, I will try and translate to the best of my abilities. But for now, I will hand the word over to you, Stefan.
Thank you, Michael. Welcome, everyone, from my side. Happy to be here. Happy to introduce our company, MPC Energy Solutions. My name is Stefan, as Michael already said. I'm the Chief Financial Officer of MPC Energy Solutions, and together with our CEO, Martin Vogt, who cannot be here today, unfortunately, I basically run the company. But I can promise you, even in his absence, you're in good hands with me, and I will tell you a little bit about our company, about why we believe we make a good investment long-term for investors such as yourself, and why the business that we're in is promising and highly scalable. MPC Energy Solutions, our company, was founded for one very simple purpose. We do believe that it should not matter where you live or how much money you have. You should be allowed to have access to clean and affordable energy. So it's about lowering emissions, transitioning the energy setup away from fossil fuels into renewable sources, and also to make sure that generation costs for the electricity and energy is as low as possible, so that everyone can truly have access to clean and affordable energy. I think learning about our company, being introduced to our company, the timing couldn't be more perfect. We are out of the ramp-up phase. We were launched in early 2021 when we went public on the Oslo Stock Exchange. We've been investing the money we raised ever since. We now have the first assets under operation. We have several more under construction, and we have a very large and promising development pipeline of new projects coming up. So the initial risk of us not making it through the development and construction of our first projects is behind us. The scalability will soon kick in, since our overhead more or less remains flat as the asset base and revenues and cash flows from these projects grow. And we can also start optimizing the power plants and the assets that we already have. So before we start looking into what we actually do, let me just highlight a few things. The track record that we've built over the past 2 years and even before that shows that we've delivered the proof of concept and that we can now start scaling up our asset base and our activities. We are in a region that many consider to be very risky, exposed to currency fluctuations, etc. But it's actually true that we work with very, very solid purchasers of our energy, with which we have long-term agreements denominated in paid, mostly in United States dollars. We have local feet on the ground. We have offices in Panama and Colombia. I will get to that in a minute. So based on everything that we have, proven technologies, very, very promising, strongly growing markets, the need for energy transition, and potentially high returns, this is really the value case that we can present in our company.
And Stefan, there was actually a question here regarding, the currency risk and the inflation risk. You normally hear this about those countries that can run crazy and affect the currency. So are you telling me that most of your contracts are in US dollar, but what about your cost base and so on? Is there any high inflation countries, and do you need to handle that somehow?
Of course, as you can imagine, inflation is a subject in this region, like everywhere it's in the world right now. And I think this is quite a loaded question. So to our own setup, we operate in Panama, we operate in Colombia. This is where our local teams are. In Colombia, we pay everything in Colombian pesos. In Colombia, our projects generate cash flows in Colombian pesos, while the construction costs are usually denominated in US dollars. So during construction, we don't necessarily have a large currency exposure. And over the past few years, the United States dollar has actually appreciated against the Colombian peso. So here, we've benefited from that to a certain extent. And in Colombia itself, we have what I would call a natural hedge Our cash flows are both on the income and expense side in Colombian pesos. So as long as we repatriate or do not repatriate the funds out of Colombia, but we keep reinvesting them in the country, we're not necessarily exposed to currency risks other than, let's say, the value of our assets and liabilities in Colombia breathing as we report in United States dollars. In all other countries, we almost exclusively deal in US dollars, both on the income side, generating cash flows and also being paid in US dollars, and also on the cost side. And in terms of protecting against inflation, our power purchase agreements, which are long-term, mostly have indexation in them, either linked to a certain consumer price or producer price index, or with a fixed rate. And at the same time, costs are either flat or tied to revenue or also indexed. So if you look over time, the profit margins that we see in our projects are more or less stable, so that the inflation effect is visible on both sides.
Perfect. Thank you.
We decided to go to Latin America and the Caribbean as what we refer to as our launch region. So MPC Energy Solutions covers everything from Mexico down to Colombia and then into the Eastern Caribbean. And we very much act as what you could call a full cycle independent power producer. Means we usually start on a green field. We select the land, we select the interconnection points to the power grids. We do all the studies, environmental impact assessments. We engage with the local communities, making sure that their voices and concerns are heard. We sign long-term power purchase agreement, and then we build the power plants and we operate and own them for the long term. We do not necessarily have a preference to exit projects at any time. We consider ourselves a long-term owner and operator of these assets, but that does not mean that we not do sell smaller stakes to co-investors, or that we take the opportunity sometimes if we think selling a project ready to build makes more sense from a pure return perspective than investing in the construction itself, then we might do that as well. Once we have, sorry,
yeah, regarding the grid quality, you know, I when I read about this region and read about investors, then there's a lot of irradiation. You will show that later on. There's a lot of possibilities, but some are talking about the grid quality and the problems of connecting this as maybe the main problem investors or managers, project managers face in this region. So how are you handling this, or is it an incorrect view of this region?
No, I would say it's partially correct. You do have large countries with very solid grids that have been investing in the grid infrastructure for many years now, that are even run by international companies like AES from the United States, where you find very, very good grid infrastructure and you do not have congestions or necessarily a problem to find connection points. You do have countries where that is not the case, of course, where new substations need to be built for your plant to be connected, where the grid infrastructure needs to be expanded as well. But all of these countries are very much committed to that. They're allocating investments to it because they know the energy transition from fossil fuels with let's say, low grid quality towards a properly running energy system based on renewables can only work if you have a strong infrastructure. So we're still a small company with only a handful of projects, so to speak. And at the moment, we do not see issues like that arising. What we have seen is that sometimes we build our power plant, the power plant is ready, and then we have to wait 1 or 2 months for the substation to be ready because the grid infrastructure is not executed as well during the construction site. But the plants are able to connect. We don't see a lot of losses because of congestion. And in some cases, we're even directly on the premise of our client who's purchasing the electricity in sort of like an island off-grid mode. In which cases that does not matter at all.
Perfect. Thank you.
So other than covering the whole value chain from development construction through long-term operation, there's also always a question about which technologies do you focus on. And we like to say that we are technology agnostic. It is clear that the region, and we will get to that in a minute, has a strong preference for, let's say, solar and onshore wind, because of this being natural resources that are simply predominant in the region. But if we have a client, let's say a pharmaceutical company in Puerto Rico, who says, I need 24/7 power supply, solar doesn't really cut it, wind doesn't really cut it, what can you build us that will help us get less dependent on the existing grid and on the fossil fuel-based generation and transition to a cleaner setup? then we will find ways to make that work, either by bringing in batteries or by using a transitional technology like combined heat and power based on liquefied natural gas. So it's the client's needs that is most important, always keeping in mind that it has to lower carbon emissions and it has to lower costs of generation ultimately, so that the off-taker truly benefits from it in multiple ways. Looking at our current portfolio, these are the projects that are either in operation or under construction already. This is what we have. We have projects in Mexico, Puerto Rico, and Colombia, in El Salvador, and also on the island of St. Kitts. And on top of that, we have a large development backlog of currently 450 megawatts of solar projects and in part hybrid projects from Mexico, El Salvador, Guatemala, Colombia, and then Jamaica, Dominican Republic. So we are truly a regional player, active in 9 countries at the moment, from 0 countries when we started after the IPO. And the brand MPC and the activities that we've done, they're very well known in the region. We have made a name for ourselves in a very fragmented market that is not attractive enough for the super large players, because you do not find the 500 megawatt projects that, for example, a Scatec is focusing on. But you will find plenty of projects with 25 to 100 megawatts, which is our sweet spot. And we see a lot of local developers that don't have the financial capabilities to execute those, bring them to operation. And we see the large players not really coming in, and this is where we fit in. This is where we come in, where we are a partner to local developers, where we are a large enough company to make it work financially. And this is what we've built over the past 2 years since the IPO. The projects currently under construction, as you see here, they will be connected to the grid this year and next year, meaning that the entire portfolio that we have built with our IPO money in the first investment phase will be fully operational by the end of 2024, and we will see for the first time the full financial strength of these projects in 2025. And you will see a prediction later on in the presentation. I've spoken about the companies that we sell electricity to. Here you see who they actually are. We are very much focused on private, corporate, and private utility off-takers, but we do also work with state-owned utilities where the power grid and the need is simply run by government agencies. Some of these names you will recognize, like Johnson & Johnson, a very, very big pharmaceutical company, or like Leonie, a cable manufacturer. We work with large corporate private utilities like Celsia in Colombia, or like AES El Salvador, a subsidiary of the conglomerate in the United States. And in February this year, and we are very proud of this, we also signed a long-term power purchase agreement with the IMSA Group, which is one of the world's largest sugarcane manufacturers and sugar refiners. And at the end of the day, the risks that we see, it's not so much related to which country you operate in. I mean, this is the global investor perspective. You want to invest in El Salvador, you look at how bonds in El Salvador are trading, government bonds, and you're saying, this is too risky for me. When you look behind the curtain and you work with a company like AES El Salvador that has built a very, very solid and stable energy sector, then that country risks goes away to a certain extent. You're still exposed to regulation and to, let's say, potential political shifts. But at the end of the day, what matters is that the plant is technologically running fine, and that the off-taker is paying its bills. And with the companies that we work with, they do that so that the country risks that some people see do not necessarily apply to the individual project.
And the business model by you is purely, if you don't have a PPA, you don't build, or can you build something in advance and then try to get a PPA, or how does this work? How much risk do you take on before the PPA might be signed, and the cash flow, credit risk will be known?
There is development activity ongoing before a PPA is signed. Simply, if you secure the land, you secure the interconnection, you always have the option to build a plant and sell to the spot market, or to find a power purchase agreement off-taker later on. But we predominantly see that the PPA is already signed way in advance before starting construction. And this is also a matter of bankability. We want to finance these projects with project debt. We don't want to go in all equity, because that's expensive and it's not the best use of our capital in terms of allocating it to different off-takers, technologies, and countries. So the banks will very much look into how much is the spot exposure, how long is the PPA, what are the PPA conditions. This is really one of the key criteria for securing debt and for the debt pricing itself. So we, of course, will try to sign PPAs before we start construction.
Before construction, and I guess that's when the real cost comes. You know, I know 5-10% is that around before you start construction. So limited risk before you actually have a contract that is well-known cash flow and a well-known credit risk. Perfect.
Absolutely. Let me give you and the audience a feel. To get a project from greenfield, there's absolutely nothing too ready to build. We calculate that it costs us around $10,000 to $15,000 per megawatt. And then the real, as you say, the real expense comes with the construction investment costs required. So I would say the risk of a project not making is of course higher than you've reached ready to build. You just need to build the plant, but the costs are also fairly low compared to what's coming during construction.
Yeah, perfect.
As you can imagine, there we go. As you can imagine, ESG is a topic that is very dear to our heart. We actually do see it as a competitive advantage also in the region. There are a lot of companies out there just talking. Yes, we are caring about the environment. We are engaging with the communities for our social responsibility, and we have a strong corporate governance. We actually live by the highest standards. We engage with the local communities from the very beginning. We try to understand what are their needs, how will our project impact them, and how can we find a good balance between them benefiting from it and us benefiting from it. So we do have a strong ESG team. We do have our guidelines and policies. We follow the highest standards. We report under the GRI standards. Next year, the ESG report, we've published 2 already, will become part of the annual report, meaning it will also step by step become part of the audit process. We take this very, very seriously, and we start with it from the very beginning, and also in due diligence phases, of course, when we acquire a portfolio or we look into a third-party project.
And I guess a competitive advantage could be, I guess, are you able to finance cheaper because of the ESG and this one, getting Western debt, you might say that is more green or ESG focused, maybe compared to what the risks are associated with some of your competitors in the region.
So what we do see is 2 things. We see that if you actually care and if you actually, walk the talk, you put your money where your mouth is in that sense. Local communities and, let's say, the people behind it that are trying to drive the energy transition, they do appreciate it. So if you have the choice between selecting a developer like us or someone who doesn't really care about it, who has a poor track record of ESG compliance, you will find that people will, even if the pricing is similar, go with us because this is important. About your question on financing, I think there's been a debate whether a strong ESG compliance reporting KPIs lowers your cost of debt. And I would say the feedback that we've received is mixed. There are some institutions like the IFC who say, if you implement a strong ESG KPI criteria, you track it, you report it on a regular basis, you follow the highest standards, you can benefit by getting a lower interest rate on your debt. And then there are those who say, look, this is a green technology anyway, you're already doing what you can, but cost of debt is cost of debt. So I would say it depends on which financial institutions you work with.
Perfect.
Now, the question that we always get is, why should I care about renewable energy at all? And why this particular region? And we've selected a few information points that you might find helpful. The first thing is, and this is not a surprise to anyone, renewable energy is a mega trend. Energy transition is a mega trend. You will see the world shifting from the fossil-based power generation setup it has today, and it will transition into renewable energy. And the region that we're in is no exception. Almost every country that we are active in has made very, very strong commitments moving away from the current setup that they have, which is mostly fossil-based, to a green setup. Whether that's by 2030, 40, or 50, these targets have been formulated. The governments are supporting it one way or another by providing tax incentives or by providing, let's say, government-sanctioned land for these purposes and entering into long-term lease agreements with you. So there is a huge uptick, and this uptick is in industrialized nations, but in particular in developing and emerging markets who have, let's say, so much more work to do, but therefore offer a very large growth opportunity. And then, if you look at the world as a whole, the Caribbean and Central America are very unique, or not unique, but very special in one aspect. If you look at solar radiation, they are in the solar belt. You will find some of the highest numbers of irradiation in the world in these countries, compared to Northern Europe, where you live. That's very natural. We are more a wind resource than we are a solar resource. The south of Europe is a little bit different. But Central America and the Caribbean, they have the strong solar resource, and at the same time, they have a lot of coastal lines, both on the Atlantic and on the Pacific side, which makes it a very good wind resource as well. So we have access to different technology in a fairly small part of the world. And this is why we see that if we take a proven technology like solar PV, which is the same whether you install it in Norway or Sweden or Denmark or Greece or Central America, but you pair it with much higher radiation, and as you will see also in some cases, much higher power prices, so that you can see the uptick on returns and be compensated for the additional risk that you're taking. And once we're done in this region, if you look at Southeast Asia and the island nations of Australia, they basically have the same market characteristics. They're more or less in the same solar belt. They also have the advantage of a lot of coastal lines. So this would be a natural expansion region for us as well once we have fully executed on the pipeline in Latin America.
So there is no differences in the solar park you build. You don't need to build in some cooling. They can't get too hot there. It's really some small changes. But in general, you take a solar park you would put up in Denmark and put it up in this region and simply get the higher irradiation. Is that correctly understood, or is there something special that needs to be put in those solar park?
For Central America, this is exactly the case. You have the modules, you have the substructures, maybe the trackers, you have inverters, and that's the technology. That's not different. And the module manufacturers and suppliers are the very same. Yeah. The inverter suppliers are the very same. In the Caribbean, the only additional aspect you need to consider that in some countries you have to build solar plants that can withstand hurricanes and other natural disasters. But that has been proven for a long time. And if you sometimes look at countries that unfortunately have been devastated by a hurricane, the solar plants are usually more or less intact. You pay more for insurance and you have to build extra protections in, but the price difference to make that work is compensated by the higher power prices that you secure under your agreements. But otherwise, same technology, much better natural resource, and also higher prices that you're exposed to usually.
Perfect.
As I mentioned before, Central America and the Caribbean, they have very special market characteristics that make them super attractive. As I said, they all have ambitious energy transition goals. They either have almost no renewable installed base or a very undiversified renewable base. Like Colombia, for example, has a strong renewable base of hydropower, 70% of the total installed capacity. But it's only hydropower, so to speak. They need to diversify their energy mix to be less dependent on weather phenomena like El Nino this year, which brings very, very dry weather, meaning the hydro plants cannot be run as efficiently and as they're used to, and that increases spot prices and the cost for everyone. You look in the Caribbean, you see it's mostly diesel generators running. 95% in some cases, countries are dependent on diesel fuel, which not only now during times where energy prices are very high, but also normally lead to very, very high generation and consumption costs on the energy side. So we see these as strong reasons why transitioning to a renewable base makes sense, and why we see this region offering so many opportunities to us. And last but not least, why also to invest in Central America and the Caribbean. On average, in our portfolio, we are currently getting around $100 per megawatt hour, compared to, let's say, half of that what you could get in Europe. And as I said, based on the same technology without really incurring extra costs or necessarily higher risks because you think El Salvador is more risky than Denmark. It certainly is, but maybe not to the extent that, if you just look at it from a meta perspective, is actually true. To wrap this up, I would like to speak a little bit about where we go next. We have very ambitious targets. We currently have in our portfolio the 7 projects that I showed you earlier, 112 megawatts of install capacity. We want 9 to 10 times that by the end of 2027. This will, of course, require a lot of money. This will require a strong development backlog that we're building. Either we already have it, we're signing new development partnerships, we're entering new markets. This year, we just signed a development partnership in Panama, and we started new developments in El Salvador, all with the clear ambition that MPC Energy Solutions wants to be the regional leader in the region, the leading IPP, and leading also with excellence in ESG. And even if you say, wow, this is very ambitious, how are they ever going to do that? Well, I'm sure that we will do it. I'm optimistic. That's why I invest in the company, and that's why I work for it. But even if you just look at the existing portfolio we have today, the 4 projects already on operation, the 3 under construction that will go into operation this year and next year, you can already see how scalable the business itself is. Because for this, we will not need any additional personnel. We don't have to spend any more on development. We just have to build them, put them in operation, and manage them well. And you will see us grow into a $20 million revenue company with a 75% EBITDA margin. That growth opportunity is already locked in. The value is already secured through the long-term PPAs for the fixed capex, and by removing the construction risk month by month, step by step, or either already having them in operation. So even if you adjust for some, let's say, projection errors, or you don't really buy into the whole long-term growth story, what we've created today, the intrinsic values of the projects we've created today, is more than we have invested. We've invested around 60 million in projects over the past 2 years. And depending on what discount rate you apply, they are worth from 70 million to 110 million over their lifetime. And that's just a fact. That just happened. So even if we don't secure any additional funding, what you see here, this is what we are definitely building. And as we are in 2023 and we're nearing the end of the second quarter, we are very much on track to meet our predictions. In solar, the third quarter is the most important one. That's the summer month. That's the high radiation months. So at the end of the third quarter, we know where we will end up by the end of the year, but it's looking very good so far, and the growth prospects also look very good. The last slide I have here is just an expression of, if you look at our books today, the fair value balance sheets that we have that have been audited, that reflect the investments that we've done, you will see that we are currently trading, and this is an investor presentation after all, so you don't mind me saying this, we're not only sufficiently trading below our book value, but I also think significantly below our intrinsic value. And at the end of the day, I think this makes MPC Energy Solutions a very, very promising investment case, both short-term and long-term. And I do believe that the small team that we don't even have 20 people on the payroll. If we work very hard, if we continue to focus, to remain lean, and to execute well, then what we've done over the past 2 years, the actions that we've taken, they will turn into results, the results that I showed on the previous slide. And also over time, the value of our company will be recognized by the market, and we will see an uptick in the stock closing in to the intrinsic value and the book value that we see. And with that, I'd like to close my remarks, but I'm of course, not only thankful for the time, but also very, very happy to take any additional questions you might have.
Perfect. Let's just jump to the first one. What comes to mind is that you are in it for the long run. But when you have such a clear discount between your share price and the share price and the equity value just of the projects, one way of showing it would be to sell a project, to show that Latin America, if you build it, you get this, you get the return. You can finance it, if you understand what I mean. Simply to show out, and I know this is a little bit stupid to do, just to prove to the share market you can do it in depending on your plan. But is it a way you are thinking? Or is it more maybe to, as you also mentioned, that this was the project cost, you also have some development cost to carve that out, so investors can really follow. This is our project cash flow and earnings. So a little bit of thinking on what should close this gap. What should we look for closing it?
All right, I think you're right. The share price is too low, and we could provide the market with information that convinces them, hey, what they've done is actually worth way more. Okay, it's not just Stefan saying that these are the predictions, and there's two ways of doing it. We can be patient, and you will see quarter by quarter as we report our numbers that what we've done will reflect in higher revenues and higher profits over time.
Yeah.
Or as you say, we could sell parts of our portfolio, maybe a stake in the development projects or a development project itself. For us, it's not so much about proving what the company is worth, but doing the right thing for the company. If we think bringing in a co-investor for a large project at the ready-to-build stage, we will do it. If we think that a project is best sold at ready-to-build to someone rather than doing it ourselves because maybe our return expectations have changed or are not being met by the project itself, and there are companies out there with lower cost of capital, we will do that. But at the end of the day, this is a case-by-case decision, and it's not so much about just giving up future value for some cash today to prove to someone that, hey, you've been wrong all along, because I think if you spend some time looking into the company, you will figure that out very quickly yourself. We can also not forget that we have a very stable investor base. Around half of the company are owned by only a handful of investors who are also in it for the long run. And that keeps trading in the stock low. And of course, stock liquidity does play a role when you look at how a stock price moves on every given day. We think we have all the right ingredients. We have a solid base. We have a good team. We have the growth projections secured that I shared here today. And then the rest will just have to play out over time. And we still want to make the right decisions and be mindful about it. And there are ways to raise capital without going to the market. And as long as we see growth opportunities, we will try to secure funding in whichever way we can to scale up further and to build an even stronger business case.
There's a question here. Are you looking for large investor in the region? I think it means that are you looking for some investors in that region who maybe better can handle, the thinking about the political risk and such stuff, or are you more looking to the western side to fund your 1 gigawatt ambitions?
I think it will be a healthy mix. You're absolutely right that local co-investors, large companies that are interested in the energy transition in these projects will play a very important role as we find co-investors for individual projects or maybe country-specific co-investors. But at the same time, we're also mindful about what our shareholders want and can do, or what kind of, let's say, corporate debt financing is available to us. So we're tapping into all layers that are available to us, and whether that's co-investors on a local level or debt on a corporate level, or at one point going to the market and raising more equity capital, time will tell. And we also still have, of course, we cannot forget the cash flows that our own projects are generating, and that some of these assets are still unlevered with no project debt. So there's also a lot of possibilities to recycle cash and to find funds within the projects that you can then further deploy. But to your question, co-investors locally will play a very interesting role for us. Yes.
And then there's a question: how do you handle estimate political risk when taking an investment decision? I think that's one of the risk factors. So how do you handle that in your big, I guess, risk paradigm on whether to do the investment or not to do that?
I mentioned very early on in the presentation as one of the investment highlights, and maybe I can just briefly bring that up again so that you have some visual aids. There we go. Our people, we have people on the ground in offices in Colombia and Panama. These are not people like myself from Germany who you send over who don't have a clue. They don't know what's going on. We're speaking about proper local personnel that grew up in these countries, that have the local networks, that are very much familiar with how things are going in these countries, and that can help us in a much better way to assess what the actual risk exposure is, both politically as well as with respect to the individual off-taker. So we have different risk categories. We assess all of these risks very carefully through due diligence, through external advisors that provide us with power price predictions, or that provide us with information on the individual off-taker. Is this a solid company? We have a local network of banks that help us make that assessment. And at the end, of course, you never know what's actually going to happen. But we familiarize ourselves very much in detail with the market itself, with the political situation, with the off-taker sphere before we make an investment decision. And these things are being discussed very carefully on the board level, both between Martin and myself and also on the supervisory board level, so that we can make sure that we enter a country, we know what we're getting into. And certain countries are off limits. We will currently not look into Nicaragua. We will not look in Venezuela. Haiti, Cuba, these are for several reasons off limits. In every other country, we just need to be very familiar with it and have a good understanding of what's likely to happen. Because as you can imagine, if you operate a power plant for 30 years or longer, you're really making a commitment. And we need to make sure that that commitment is being upheld from both sides of the equation.
There's a lot of talk about Chile, and I saw BlackRock would invest around $4 billion into that. It seems that they have built up a very smart, very profitable paradigm for companies to invest in smaller solar plants. So is that a country you're looking at also?
Well, let's say not actively, meaning we're not signing development partnerships and sending people out to acquire projects, but we see the opportunities that are also out there. We are eyeing the situation. Same in, for example, Ecuador. We've actively looked into projects. It's on our radar without being the predominant focus. I mean, Chile has, I think, have exceptional success 10, 15 years ago when solar thermal power plants come up, and they've with the high radiation, they've already built an interesting platform. Maybe they use that advantage a little, and now things are picking up again. So I'm not ruling out Chile as a country in general, but at the moment, let's say the 1 gigawatt that we're trying to build, Chile does not play a role in that.
And then finally, a final question that we ask all the companies in this world. It seems that panel prices and such are coming down globally. Do you see that in that region also? I guess when it's a global market and it's not matched by, so in general, is the cost curve coming down on building the park also in your region, as I tend to hear about in other places, actually matching the rising interest? So is that also that fact or is it also in your region that?
Yes, absolutely. As I said before, we are purchasing the modules from, let's say, the top 5 top-tier providers that you have in the world, whether that's First Solar, Canadian Solar, Longi, Trina, you name it. And we see prices coming down. I think during COVID and with all the logistical supply chain issues, we were at one point at, let's say, 24, 25 cents per kilowatt peak, per watt peak, sorry. And now we see for the next year already, if we place purchase orders 18 to 19, and the Chinese recently announced that they want to get to as low as 15 cents by 2025. They've built the capacity. They're continuing to ramp it up. And my expectation is if Chinese companies make such an announcement, there's usually a very, very clear plan behind it. So I think we will continue to see polysilicon prices drop, module prices drop, as interest rates have now increased. Costs have to come down to protect returns, and we see that happening, and we will benefit from it with our next investment phase.
And maybe I put the words in your mouth here, but thinking on that China will be the big producer of this and bring the cost down, but it might, if you're a European developer, it might come with a hefty price tag on taxes. I guess that region might be a little bit protected from the war we are having, the West against the Chinese. Something you have heard from your investors that see as an advantage in your region. I think it's just on top of my head. I'm thinking that that European producers or developers in European can be hit by tariffs because of our fight with China. And I guess this region might avoid that a little bit, or don't want that.
Well, at the moment, I'm not aware. We are not aware of any discussions in that direction. I think that ultimately, I don't see a trade war between China and the region that we're in. I don't see companies announcing already that they will punish us for it one way or another. So, and when we speak to our largest investors or partners, that is never a subject. No one is really bringing up the problem. So at the moment, I would say the risk of that is very, very low. We will benefit, hopefully, from interest rates coming down over time as we put more leverage on our projects. We will benefit from module prices coming down, capex coming down. The projects are there. We will secure the funds for it, and then we will grow from the 100 megawatt we have today to 200, 500, and ultimately a gigawatt in the region. I'm very, very convinced about that.
Let that be a very good final word. Thank you to you, Stefan, and thank you for the listeners listening in.
Thank you also from my side.